Every buy now, pay later loan you've ever taken out was invisible to your credit score. That changes in 2026. Klarna, Afterpay, Affirm, these companies have operated completely outside the credit bureau system since they started. That's not a loophole. That was the design. Now, the two companies that build the algorithms behind your credit score are rebuilding those algorithms specifically to include this data. Here's what that actually means for you. If you have ever used a buy now, pay later plan, your credit file is about to change, whether you did anything differently or not. In plain terms, a type of loan that never touched your credit score is being folded into the exact same system that scores your credit cards and your mortgage. To understand why this matters, you need to understand what a trade line is. A trade line is simply the technical term for a single account entry on your credit report. One line, one lender, one balance history. Every credit card you have is a trade line. Every auto loan is a trade line. Until now, buy now, pay later loans were not. That's because buy now, pay later loan companies structured these loans specifically to avoid standard trade line reporting. Most buy now, pay later loan plans are short-term, often 4 payments over 6 weeks, and many carry no interest. Under the older FICO and VantageScore models, a loan that's short and that's structured either didn't get reported or got reported in a way that scoring algorithms couldn't properly weigh. The newest FICO scoring model changes that. It's built specifically to recognize buy now, pay later loan trade lines as their own distinct category. Here's what that actually means for you. The algorithm no longer ignores this data. It reads it, weighs it, and factors it into your score using its own separate treatment. That separate treatment matters. A model that misreads a 4-payment buy now, pay later loan the same way it reads a 5-year auto loan would punish short-term borrowing patterns that have nothing to do with actual risk. So the new models are being built to distinguish loan structure, not just loan existence. Here's where it gets more specific to how banks actually process this. Lenders don't see your credit score in isolation. They see the full trade line history behind it. Put simply, once buy now, pay later loan data reports consistently. An underwriter reviewing your file can see exactly how many buy now, pay later loans you're carrying at once, not just whether you've missed a payment. That's a new visibility layer that didn't exist before. Multiple concurrent buy now, pay later loans, sometimes called loan stacking in industry reporting, is a pattern regulators and lenders are now specifically able to see for the first time. A lender's internal model doesn't just ask, does this person pay on time? It asks how many short-term obligations is this person currently carrying, and what does that suggest about cash flow? Most people hear this term and move past it. Don't. Cash flow visibility is a different signal than payment history, and it's one banks have wanted for years. This is why the timing lines up with buy now, pay later adoption data. As more of these loans exist, the blind spot they created got too large for underwriting models to keep ignoring. There's a regulatory layer here too. The 3 credit bureaus themselves aren't the ones deciding to add buy now, pay later data. They're responding to structural pressure from both scoring companies and regulators. Here's the part they aren't telling you in most coverage of this. Reporting standards for buy now, pay later data are still inconsistent across providers. Some buy now, pay later companies report every loan. Some only report if you miss a payment. That inconsistency creates a data quality problem the industry hasn't fully solved yet. Strip away the banking language and here is what is actually happening. Different buy now, pay later, companies are sending different kinds of information to the bureaus, which means 2 people with identical buy now, pay later usage could see different effects on their file, purely based on which provider they used. That's not a rule you can control. It's a structural inconsistency built into how this transition is happening. So here's the full mechanic, start to finish. Buy now, pay later loans existed for years completely outside the credit scoring system. That created a blind spot for lenders trying to assess real repayment risk. FICO and VantageScore built new models specifically to close that blind spot. treating buy now, pay later loans as their own distinct trade line category rather than lumping them in with traditional installment loans. That gives underwriters a new visibility layer into short-term borrowing behavior that didn't exist before. And because buy now, pay later providers report inconsistently to the bureaus, this transition is uneven. The same usage pattern can show up differently depending on which company you borrowed from. In plain terms, a loan type that used to be invisible to your credit file is now becoming visible, and how visible depends on which company you used, not just how you paid. This is a structural shift in what credit history even includes, and it's happening in real time.